So Ronas Academy welcomes you back to our various lessons. We've been away for quite a while. It's due to some technicalities that is outside our control. But the most important thing is that we are back. God being so good, we are back, and expect from us more in-depth lessons on most of the standards, the accounting standards. And also, we are going to expand our business-related courses. We are going to have lessons on management accounting and financial management subsequently. And also, with the previous videos, there have been a lot of revision in the standard, and even those that don't have that have not been revised, we will still have revised videos on them where we will go into details and possibly solve more practical questions to augment understanding. And in case you need any questions or even in a professional um, area, you can be able to apply the standard and you have no hurdle at all. That is the focus and the aim of Ronas Academy. We always want to comprehend the complications. So, Ronas Academy, we are back and expect from us more valuable lessons on the various IFRSs, on man accounting, on financial management. We'll probably add some financial accounting as well as we progress through our lesson. All right. So today we want to look at a very important, um, slightly topic or a standard in FR, that is financial reporting, and basically it also runs through corporate reporting. Most people call it advanced accounting. Yeah, and this is going to be IAS 33. IAS 33. So today we want to focus our discussion and a lesson on IAS 33. And when we talk about IAS 33, it's basically looking at earnings per share. So we are basically looking at earnings per share today. Now, what is earnings per share? Now, when you take earnings per share, it's very important because currently most published financial statements are required to calculate or also required to present earnings per share in their published financial statements. So earnings per share is one of the important topic or standard that you are supposed to consider in your journey of IFRS. Another important thing is that when we talk about earnings per share is a very important indicator of business or company's performance. What do I mean by that? I mean to say that you may have profits at the end of the period. Entities may, account for profit at the end of the period. But investors are basically looking at earnings per share to make any relevant decision. Don't worry, we will go into details and look at what is earnings per share and how we can determine earnings per share under various conditions, under various scenarios, under various circumstances. So you don't have issue with that. Now I'm trying to let you know the importance of earnings per share. Now, so like I was saying, it's one of the indicator to measure the performance of a business aside using profit and other ratios. And also, we use earnings per share in the computation of one most important stock ratio, and that has to do with price earning ratio. If you want to determine price earning ratio, basically we refer to it as P ratio. We are saying that it's going to be your market price per share, all divided by your earnings per share. So probably we'll be looking at business valuation in it counts in financial management and also advanced accounting, that is corporate reporting. And when you are doing that, we are saying that if you want to determine the P ratio is one of the most important stock ratio. Investors mostly look at the P ratio of entities to decide whether to invest in that particular company or not to invest. So it helps them to inform their decision or influences their decision. Okay. So I'm saying that we use earnings per share in this computation. Aside it being a very important indicator to measure the performance of business, we also use it in the computation of one most important, ratio. So earnings per share is very important. It's very, very important, and we need to focus on how to determine earnings per share, and also remember that it is now a requirement that you calculate for your earnings per share and include it in the published financial statement. So today our focus is going to be on how to determine earnings per share from the beginning to the end. So what are we looking at in this particular lesson? In this particular lesson, we want to look at what we call basic earnings per share. So pardon me, I'll be using most of the initial. So we want to look at basic earnings per share. Then when we are done, we will look at what we call diluted earnings per share. So we will first look at basic earnings per share and then diluted earnings per share. Then also, don't forget that under the basic earnings per share, we will be looking at different circumstances. I mentioned it earlier. I'm trying to reiterate what I stated earlier. We are going to look at how to determine our basic earnings per share under different circumstances. So circumstances where we will have how shares are issued. These circumstances depends on how shares are issued during the period. How entities, accumulate or raise their capital through issuance of shares. So here we are looking at raising capital through equity. Then how do they raise those, resources or those capital? And your computation of earnings per share depends on how shares are issued. So we will be looking at when it is market issue, when there is a bonus, the bonus issue, and when there is a right issue. So 3, when there's a market issue, when there's a bonus issue. Probably we will look at when there is market issue plus bonus issue. They are all together. When we will put together market issue and then bonus issue and see how we can determine our earnings per share. So this is what we are going to do in this particular lesson. Right. So the general formula is that when we talk about earnings per share, the general formula is that is our profit after tax, and we are going to adjust this profit after tax. So in the next few seconds, I'm going to tell you how to determine this profit after tax. Sometimes questions will not be that lenient with you. They may give you operating profit or profit before interest and tax. Then you have to adjust those profits to get profit after tax with some figures. So I'll tell you the figures to be adjusted on the profit. Even sometimes they can give you final profit, but they might not have adjusted it with some appropriate figures. Most of it have to do with preference dividends, both cumulative and non-cumulative preference dividends. And you need to adjust it before you can get your profits to be used for the computation of your earnings per share. So stay with me as I will show you how to get that profit after tax. Then we divide all these by what we call weighted average number of shares outstanding for the period, or outstanding in the period. Now some books will say that weighted average number of shares in issue during the period. Okay, in issue during the period. So we can say outstanding during, instead of before, we can make it during the period. So the question here is, how do we determine our profits after tax? Please, mostly we leave this into is to 1, but this is not important because this is going to be a currency. So probably this is going to be a dollar sign, and this is going to be shares. So this is going to be shares. So at the end of the day, we are going to get it in a currency. So basically, the is to 1 is not, or multiplying by 100 is not appropriate because we are going to leave it in currency. Okay. So the basic formula for earnings per share is that is your profit after tax all divided by your weighted average number of shares outstanding during the period. Some books will say weighted average number of shares that are in issue during the period. All right, now we are going into details now. What is earnings per share? When we talk about earnings per share, we are basically looking at how much a share, in fact, one share is able to contribute to the performance of a business, is able to contribute to a profit. This earnings we are looking at here is a profit of the entity. So how much a share is contributed to that share, that profit. So we are looking at earnings per share. So you've invested in a business, you've invested, let's say, or let's assume that a company is capitalized with 200,000 shares. 200,000 shares. So this is the total shares the company is capitalized with. In fact, I will have a video or a lesson on these shares. What is capital, ordinary capital, issued shares, floating, right issue. So I'll have video on that and I'll explain in details how to tackle those, terms. So for now, let's just go with a company capitalized with 200,000 shares. Now with these 200,000 shares, let's say you are able to make a profit for the period. Let's say the profit is 20,000. So you made a profit of $20,000 for the whole year. You made a profit of 20,000 for the whole year. And you are capitalized with 200,000 number of shares. Here we want to look at how much is a share contributing to a profit. So in this case, we want to look at our earnings per share. Let me be specific here. This, I'll be adding B to it to show that this is basic earnings per share. This is just to distinguish it from diluted earnings per share. When we talk about diluted earnings per share, we are looking at situations where as a result of some changes in your shares number, it's not proportional. It does not give a proportional increase to your profit. Therefore, the increment in shares is not proportional to the increment in profit. So it leads to what we call diluted earnings per share. We will come there. I'm just trying to let you know so that you are not confused. Okay, we will come there where I will take you into details what diluted earnings per share is and how to determine diluted earnings per share. Here, our focus is on basic earnings per share. So in this question, or in this particular scenario, this is the profit after tax. This is the profit after tax. So it's going to be the 20,000 all divided by our 200,000. Don't forget, I'm still looking at the meaning of earnings per share before we look at how to determine this and how to determine this. Okay, so in this case, 3 zeros cancel these 3 zeros. This cancel this. So we are going to get to 1 over 10. And that's going to give us $0.1 or 10 cents. 10 cents. So we are saying that each share is contributing 10 $10, or we will say 10 cents. We are looking at how much a share is contributing to the profits, to a profit, or to a particular sum of a profit to the business or of the business. That is basically the meaning of earnings per share. It measures the amount a share is contributing to a profit, or how much you are going to earn on a share. How much profit is a share making, in other words? How much profit is a share making, in other words? So that is basically the meaning of earnings per share. Earnings per share. Okay. Having understood the meaning of earnings per share, we now want to look at the constituent. What goes into the computation of your earnings per share and how to determine it. It's not straightforward as I've done here, but it's not difficult. It's not complicated. It's just understanding of some principles. You can work things out no matter the question. Right. Okay. So we have come back to the computation of your earnings per share. How do we compute for earnings per share? In other words, how do we measure earnings per share? Like I've indicated earlier on, is your profit after tax divided by your weighted average number of shares. Now, this profit after tax here, if you have a cumulative preference shares or probably a non-cumulative preference shares, dividends. So the focus here is preference share dividends. Preference share dividends is not a dividend per se. Unless, of course, we are looking at the types of preference shares. You may have a cumulative and non-cumulative, or you may have redeemable and irredeemable preference shares. If it is irredeemable, it behaves just as the ordinary shares, but that's not what we are doing. So if you have preferred dividends in the question and it has not been adjusted on the profit after tax, you need to adjust that preferred dividends on the profit after tax by lessening it. You subtract. So your profit after tax, this is a profit after tax attributable to your ordinary shareholders. Sometimes you will say to the parent entity in the case where we are looking at the group. So it is the profits after tax that is attributable to the ordinary shareholders. In this case, if there is any preference shares dividends in the question, which has not been subtracted, you need to subtract it first or adjust it on this profit before you come and use the final profit. Take note. So this is basically how to determine your profit after tax. You first of all take the profit after tax for the period and make sure that if there is any adjustment supposed to be made on it, you adjust it by looking at preference shares dividends. Take note. Most of the times when we talk about redeemable preference share dividends, they are more or less like a loan or a debt to the business. So mostly with redeemable preference share dividends, it has already been deducted compared to irredeemable preference shares. So kindly take note of the questions and the statement. Always look at the statement. That's why you need to understand. You don't need to do fixed learning. You need to understand so that in case you get the questions in dynamic form or not as you've seen before, you can apply your understanding in solving such questions or even in the real world situation. When you get such problems, you will be able to tackle them appropriately. So that is how to determine our numerator. So always the profit after tax is the numerator, and then our weighted average number of shares is our denominator in the computation of earnings per share. Okay, now let's go to how to determine our average. So the statement here is weighted average. Now, what does this mean? This is very important. Very, very important when you want to determine earnings per share. And most students find this place to be complicated, but it's not. I'll show you. This is how to always get the weighted average number of shares. Always use this table and it will help you. Okay, so here we have shares. So I'm using a table. So this is how I'm trying to construct a table. So we have shares here. You may probably start with a date. Then we have shares, and then we have time fraction, and then sometimes you may have what we call bonus fraction, depending on which scenario we are looking at. It's not always the case that you use the bonus fraction. Okay, then we can now get our weighted average shares. Okay, what is this telling us? This is saying that this particular denominator, the weighted average number of outstanding shares, the implication here is that during the period, an entity may issue a share. So let's say that at first of January, the shares capitalized by an entity is 100,000 shares. 100,000 shares. Then at 1st of April, let's use 2020. So at 1st of April 2020, the entity issues additional shares of 20,000. Then maybe on 31st of August, that is 08/2020, the entity issues another shares of 10,000. Now, this weighted average, the principle here is that this share that was issued on 1st April was not in existence in the business for the full year. You only introduce these additional shares from 1st of April. The situation or the implication here is that it's only going to contribute to this your profit from 1st of April. So it must be apportioned for time basis. This is what we are calling the weighted average. So as for this one, it was issued from the beginning, assuming the accounting period ends is 31st December. So this is the beginning of the period. So this will take the full 12 months. But remember that while this one is taking the full 12 months, this one will not take the full 12 months. So there is a way to deal with it. There's a way to deal with it. That is what we call the weighted average number of shares. Now, there are two ways of dealing with the weighted average number of shares. There are two ways of dealing with the weighted average number of shares. So let's look at the first one. The first one is that when this is our 1st of January 2020. So in issue, we have 100,000 shares. Now, the question is, when was the next issue? You have to ask yourself that question. When was the next issue? The next issue was 1st April 2020. That means these shares was in existence for January, February, and March, only 3 months. So our time fraction here will be 3/12. You multiply by this to get a figure here. Please, I will not talk about this here. Subsequently, I'll look at it when we are looking at the various circumstances or the various scenarios. Okay, we'll talk about that one. So the bonus fraction, I'm eliminating it, but it forms part of it in some of the scenarios. For instance, when you're having market issue and then the bonus issue, you need to factor in bonus fraction. And when even there is a right issue, you need to factor in bonus fraction. So you subsequently look at that. So you multiply this by this to get this one. This 3 here is because of the next issue. The next issue. The next issue. The next issue. All right. Then you ask yourself, then you count. When is the next issue? It's 1st of April 2020. So you have your old, you can talk about old shares. So our old shares or our existing shares is 100,000 and we are adding a new one of 20,000. So now we are having 120,000 shares. Now the question is, do you have any additional issue during the period? The answer is yes. We've issued one on 31st of August 2020. So from this date to this date, how many months? So April, May, June, July, August. Because this 31st, you add August to it. So this is 5 months. So from this date to the next issue is 5 months. So we need to multiply this 120 shares with 5/12. 5/12. This is one way. I'll show you the other way. Then the next one is, what is our old issue or our existing shares? Is going to be 120,000 shares plus the new one, which was issued on 31st of August 2020. And this is 10,000 shares from what I've written on the board. 10,000. So if you add them, we are getting 130,000 shares. This is the shares in issue. But from this date to the end of the year, we didn't issue any shares again. So this is going to take the full remaining year. So from September, October, November, December, that's going to be 4 months. 4 months. So we are going to multiply the 130,000, which is 4 divided by 12. Now we need to verify your answer. You need to confirm your answer if you are correct. If you are using this approach, you need to confirm if your answer is correct. How do we do that? Add the numerators, the month you've used. Add, it must be equal to 12. So let's go. 3 plus 5 will give us 8 plus 4 will give us 12. So when you are done and you didn't get the 12, then possibly you are wrong. So always you must get the 12 when you go by this approach. So you multiply this by the shares. If there were to be any bonus fraction, you multiply this by this and the shares. Then you get your weighted average number of shares. Assuming in this case, we are getting 70,000. This is not the correct figure. I'm just illustrating. If you multiply this by, I'm not going to get 70,000, but for simplicity's sake. So if you multiply this by, let's say we are getting 90,000. Let's say it's an assumption. This is not the correct figure. So if you multiply, you may get something different from this one. All right. So you multiply this by, let's say we are getting 100,000. So we sum up all this. This is going to give us 260,000. 260,000 shares. Is that correct? Is that correct? So maybe I've inflated my figures. Let me make this one 50,000 and make this one 40,000 and probably maybe this one 30,000. So at the end of the day, we are getting 120,000. So This becomes your weighted average number of shares outstanding. This is how to compute for your weighted average number of shares. This is just one way. Another way is that we will just take the individual issues during the period and apply the month that they have been in existence on it. What do I mean by that? So let's see. So with this, the second approach, we will take the first issue. The first issue is that it was issued from 1st January in the year. So it's going to take 12 over 12. So it's going to be in the business for the 12 months. So this is going to give us the same 100,000 over here. If you do this and you do this one, you get the same answer. You get the same answer. So let's come here. Then the question is the next issue. The next issue is 20,000. Now you not add them. You ask yourself, how many months is it going to stay in the business before the period ends? How many months is it going to stay in the business before the period ends? That has to do with from April to December. That's going to be 9 months. So you multiply this by 9 over 12. Then the third one was 10,000. And with this one, how many months is it going to take? It's going to be from 1st September, October, November, December. That is going to be 4 months. We multiply this one by 4 over 12. This is the second way. This is the second way to do it. With this one, we are not doing it in cumulative form. We are not adding the shares to it. We are doing them separately. And this is how, if you do this and you do the first one, you should get the same answer. We can give it a try. The next few seconds, we can give it a try. Okay, so my calculator is here. So this is 20,000 times 9 divided by 12 will give us 15,000. It's giving us 15,000. And then the last one, which is 10,000 times 4 over 12, is giving us 333.33. So we sum this up, we are getting 15,000 plus 100,000. This is giving us 118,333 shares. So if you use this method, you are going to get 118,333. Let's use the previous one. The previous one is when we had 3 over 12, we had 12, we had 5 over 12, and then last one we had 4 over 12. But remember that it was cumulative, so you add this one. So the first one was 100,000, so it was 100,000 times 3 divided by 12, and that is giving us 25,000. Then the next one was 120,000 times 5 divided by 12, and this is giving us 50,000. And then the last one is giving us 130,000 divided by 4, multiplied by 4 divided by 12. And this is giving us 4,333. Okay, let's sum it up and see. So 433 plus, that is going to be 75,000. And it's given us the same figure as 118,333. So whichever approach you use, whether you use the cumulative approach or you use the single individual approach, it should give you the same weighted average number of shares. This calculations is going to run through all the various types, all the various scenarios we'll be looking at. So having understood what goes into the computation of weighted average number of shares and profit after tax, we now want to take each scenario one by one. When there's a market issue, when there's a bonus issue, then we add it to market issue and bonus issue, and then we possibly look at when there's a right issue, and then we look at diluted earnings per share. All right. Okay, so when so we want to look at a scenario when it is a market issue. When we say a market issue, we are basically looking at when the shares are issued at a market price, or at their current fair value. That is what we say market issue. When the shares are at their market issue, you will see in the question that, entity has issued the shares at so and so price subsequently. So let's take this scenario and see how we will determine our basic earnings per share. Assuming that a share is, a company, let's say entity A. So entity A is having a profit after tax of $10,000. Let's be more realistic because it's a whole year profit after tax. So let me add 102 to it. 102. So 100,000, profit after tax at the end of the period. Now, these are the composition of each shares during the period. The composition of each share during the period. So we had 1st of January 2022. It's capitalized with the shares of 100,000. Then there was a market issue. Maybe most questions will not say market issue, but if it is not market issue, if it doesn't come with any name, then it's probably a market issue. If it's a right issue, they will state it. If it's a bonus issue, they will state it. But a situation where it is not coming with a particular name, it's just issue of shares, then with that one, you don't have any error. Then it should tell you that it's a market issue. Because if it's a bonus issue, it will come with the name bonus issue. If it's a right issue, it will come with the name right issue. Okay. So there is a market issue on 1st of June, which is 6/2022, and this issue is 30,000 shares. And then there was another issue on 1st of November 2022, and this issue is 20,000 shares. Please remember, these are shares. These are shares. Okay, these are shares. All right. So in this question, then the question comes: what is your basic earnings per share, or what is your earnings per share in this particular scenario? Now, here our profit after tax does not have any adjustment. We don't need any adjustment. So remember the formula: our earnings per share is going to be our profit after tax. If there were any adjustments to be made, we make it on it. All these divided by our weighted average number of shares outstanding for the period. Weighted average number of shares outstanding during the period. Please pardon me with the initials. Okay. Now the focus is we already have our profit after tax with no need for further adjustment. The question is we need to determine our weighted average number of shares. How do we do that? We are going for the table. So let's go. Now you have to decide to use which of the method you prefer. Mostly I prefer the cumulative one. So I'm going to use the cumulative one throughout our lesson. So if you prefer the single one, you can also go for that. Any of them is correct. All right. So don't forget our table. We have dates. Then we have our shares in issue. Here I will not bring in bonus fraction because we don't need it over here. So we have time fraction, and then we will have our weighted average number of shares over here. Okay. So the first is, we are looking at 1st of January 2022, and in issue was 100,000 shares. Now the fraction here is going to be when is my next issue, or when was the next issue of the entity. So we come here, it was 1st June, so June will not be part. So it's going to be January, February, March, April, and May. So this is going to be 5. So I'll multiply this by 5/12. When I'm done, then I'll do the computation. Then the next is my existing share. So how much is my existing share? Is 100,000. And then my new share, which is on 1st of June 2022. 1st of June 2022 is going to be, that is going to be 30,000. So I sum this up to get 130,000 shares. Now I asked myself, when was the next issue? It was in 1st of November. So I'm going to count from June, July, August, September, October. This is from 1st, so it will not be part. So this is 5 months. So I'm going to multiply the 130 by 5/12. Then the last one is going to be our existing shares, which is 130,000. Then we have our new shares, which is on 1st of November 2022, and it was 20,000. So this is going to give us a total of 150,000 shares. Now we ask ourselves from November to December is 2 months. November to December is 2 months. So this is going to be 2 over 12. Already, I want to confirm if I'm correct. So look at 5 plus 5 plus 2 and giving us 12. Always you should get a 12. When you are going with the cumulative one, you get a 12. Now let's look at our computation. So the first one is going to be 100,000 multiplied by 5 divided by 12. And this is going to give us 41. Okay. 41,660. Let's leave it at whole number. So 41,667 shares. Then the second one is going to be 130,000 multiplied by 5 all divided by 12. This is giving us 54167 as well. Then, so this is in relation with this one. And then the last one is going to be 150,000 all multiplied by 2 divided by 12. And this is going to give us 25,000. 25,000. So we sum this together. So plus 54,167 plus 41,667. And this is going to give us 120,834. So this is going to be our weighted average number of shares. So this is just one way of determining the weighted average number of shares. Remember that you can use a single. So this one will take 12 months. The 30,000 will take from 1st June. So it's going to take 7 months. 7 months. Then the last one will take 2 months. And you should get the same figure. From here, our earnings per share is going to be our profit after tax of 100,000 all divided by our weighted average number of shares of 120,834. And this is going to give us so 100,000. This is going to give us 0.83 dollars per share. So $0.83 or 83 cents per share. That is going to per share. That is going to be your earnings. In fact, your basic earnings per share. So this is basically how to determine your earnings per share when there is a market issue. There's a market issue. So you end our lesson here. In the next lesson, you continue from the bonus issue and probably look at right issue and then diluted earnings per share. Do not forget to subscribe to Ronas Academy and share. In fact, share to your colleagues. Let them also benefit from this learning community. And also try and then like and comment and give us feedback on how you want us to improve on our lesson. We are learning community. So if you have any comments, if you want us to have a video on a particular standard, don't hesitate to leave it in the comment section. Do not forget, it is still comprehending the complications. So see you in the next lesson when we will look at the bonus issue, the right issue, and then also the diluted earnings per share. Thank you.